Hi, this is Matthew Cratter from Trader University, and today I want to talk about the Federal Reserve, its failed history, and what it means for you and your money today. If you're interested in learning how the economy actually works and how to make money in both bull and bear markets, be sure to hit that subscribe button. So the Federal Reserve is the central bank for the United States. It was founded in 1913. And if we go to their website, we can see that they have a mandate to conduct the nation's monetary policy to promote maximum employment, stable prices, and moderate long-term interest rates. So I thought we'd just go through and analyze them from the perspective of their own mandate. If we go back and look at, I found 1915 numbers. I couldn't find exactly 1913 numbers. But back in 1915, a loaf of bread cost 7 cents. A dozen eggs was 34 cents. A pound of steak was 26 cents. Often in the CPI index, they'll use what's called the substitution method. And so what they'll report inflation being lower than it actually is, because they'll say, well, you can still eat beef, even though it's going to be vegan, beyond meat, or it's going to be ground beef or hamburger instead of a pound of steak. But we can see from here that the Fed has not maintained the stability of the US dollar and its purchasing power. And in fact, prices have gone up a lot. It has not kept prices stable at all. And we can see that in gold prices. Gold prices, I couldn't get them exactly for 1915, but call it about $19 an ounce. Today, gold is trading at $1,728 an ounce. This is another measurement of the loss of purchasing power of the US dollar. But what's really worse, especially in recent years, is how the Fed has created a series of bubbles with their super low interest rates and their money printing. So the last 20 years has really been a series of rolling bubbles. We had the big stock market bubble in the late 90s that burst in 2000. And to save the economy, they decided to engineer another bubble. This was actually suggested by Paul Krugman in an op-ed in the New York Times, saying we really should get a housing bubble started to bail out the economy from the popped stock market bubble. And of course, this is what happened in the early 2000s. And of course, that housing bubble led to the great financial crisis of 2008 and 2009. And it's really the collateral damage from all of this is the American people and the global economic system. It's very, very difficult to plan for your future when you've got a series of bubbles. In the past 10 years, we've really seen the everything bubble, where real estate prices have gone up, stock prices have gone up, etc. Now, this has obviously been burst by the COVID crisis, but in response, the Fed has been printing a lot of money and again driving asset prices back to the stratosphere. Now, the problem with this, one of the major problems, is it is directly contributed. It's one of the major causes of wealth inequality. You can blame Democrats for this, you can blame Republicans for this, but no matter who's in office, we have the same devaluation of the US dollar, which disproportionately hurts the middle class and the working class, not to mention shipping all of our manufacturing jobs overseas, which is has been part of the policy. But here we see the distribution of family wealth and how the 99th percentile has really exploded versus both the 90th percentile and the 90th percentile. And versus the lower percentiles, the 10th and 20th percentile, it's been absolutely enormous. If you just look at the multiples of the 10th percentile versus even the 90th percentile, these numbers have really absolutely exploded. And I'm going to show you a little bit why this is happening. When the Federal Reserve started in 1913, there were 23,000 banks in the U.S. Now, obviously, the population was a lot smaller back then, but nevertheless, there are this many banks. And part of the Fed's policy has been to be like an evil vacuum cleaner that sucks up all the banks in the U.S. And now we just have these very major banks. Obviously, there are legislative changes that were made, regulatory changes that were made that allowed this. But one of the main purposes of a central bank is to expand its own power. We've certainly seen this in Europe, where the ECB, since its founding in 2000, has become more and more powerful, taking over aspects of everyone's lives. So back in 1913, there were 23,000 banks. Now there are only 5,000 banks, and we know that there are really some really big banks that control the system: the Citibanks, Bank of America, Wells Fargo, J.P. Morgan, etc. And the problem with having this sort of concentration is you get bank blowups and bank failures, as we came very close to, even among the major banks in 2008. So not only has the Fed failed to stabilize purchasing power and prices, it's also created this series of rolling bubbles. It's created a lot of consolidation as well in the banking system, where the power is increasingly concentrated in just a few hands. In addition, part of their mandate, of course, is to maintain full employment as they can without causing quote-unquote inflation. If we look at the labor participation rate, which is a little bit better to look at than the unemployment rate, it was at 85%. Now, this is among men in 1920. It was the closest statistic I could find. But this gives you an idea. Obviously, the participation rate has fallen off a lot due to COVID. We'll see how much of this bounces back. But even so, it has fallen off a cliff since 1920. And one of the reasons for this is that things used to be much more equal. Back in 1913, there was less of a gap between the rich and the poor, and there weren't people like Jeff Bezos hoovering up so many dollars, while the people earning the minimum wage were seeing their purchasing power fall again and again. Obviously, the COVID crisis has exacerbated this, and we're seeing a lot of small and medium-sized businesses failing. This has been good for the stock market in the sense that big companies like Starbucks, Home Depot, obviously all the other big companies are able to take market share in an environment like this. But this is another example of never letting a crisis go to waste. And when you have a Fed policy propping up the stock market, what it does is it gives currency, it gives purchasing power in the form of stock and debt to large businesses, and gives them a real advantage over small businesses. So just as we saw the number of banks shrink, we've seen now the number of businesses really, really shrink. So yesterday the Fed came out and said, June 10th, Wednesday, Fed came out and said it will keep stimulus coming for years. My translation of this was, and I almost entitled the video this, Fed promises to pump gold and Bitcoin prices for years. We've already seen how gold just goes up, always goes up over long periods of time, because the Fed is constantly debasing the purchasing power of the US dollar. This is what the Fed does and what they've been doing, especially this year. They print new money. This is Chairman Powell. Obviously, it's digital money, which they created a keystroke. They don't actually have to print it. But then what they do is they buy assets with it. So yesterday, the Fed announced that it's going to keep buying bonds. And a lot of people don't realize that they're actually printing new dollars to do this. So if you have dollars in your pocket, it devalues them. And if you're middle class or working class, you probably have a lot fewer stocks or real estate, if any. And what this Fed policy does is it makes real estate prices go up and stay up. It makes stock prices go up and stay up. And so it really hurts the middle and working class, and it makes the rich richer. But the Fed said they're going to keep buying bonds, targeting $80 billion a month in Treasuries and $40 billion in mortgage-backed securities. When you get a mortgage on your house, they roll them up in these securities, and they're traded on Wall Street. This is a tremendous number of Treasuries. If we look at the number of Treasuries that the Fed holds on their balance sheet, so they basically print new money, they buy U.S. Treasuries, and this has been skyrocketing. It's really been going up since the 2008 crisis. They tried to taper down their Treasuries back in 2018. It caused a little mini stock market crash, and you can see this chart is just up and to the right. The Fed is basically sterilizing or monetizing the U.S. debt. And the reason it's doing this is because there's no one left to buy our debt. The U.S. is pumping out so much debt every year, and foreign investors and foreign and international investors haven't been increasing. They've increased their purchases really marginally, but you can see it's been fairly flat for the last 5-6 years. It has gone up over time. We can see that this is when China entered the WTO. China's been a big purchaser of our treasuries, but not doing it anymore. Now, we keep creating more treasury securities because we're running these giant federal budget deficits. This is where we're spending more money than we're bringing in taxes. This U.S. debt clock here currently has it at 3.1 trillion. There's talks of another trillion or multi-trillion stimulus package later this year, and it looks like we may be getting a second wave of COVID, so that makes it more likely. Either way, this is money that needs to be made up for by selling new debt. Now, there's no international investors to buy it. There are not enough domestic investors, and so as a result, Mr. Powell has to print new money and buy these treasuries. So you basically have one part of the government buying debt from another part of the government and creating new money to do that. Again, a lot of you will tell me the central bank's not part of the government. Technically, this is true, but when we see power structures working together, we can somewhat lump them together. In fact, it may be that the central bank is much more powerful than the president or Congress or any part of the federal government. But I expect the Fed's balance sheet to continue to explode. They have to buy U.S. Treasury securities to keep rates low. This is the only way they can do it. Otherwise, we would have skyrocketing interest rates because we are pumping out so much debt every year. This is the mortgage backs that are being held by the Fed. Basically, our central bank, the Federal Reserve, is printing new money, buying everything. They're buying junk bonds, and we're really headed toward a situation like we have in Japan, where the Bank of Japan, their central bank, actually owns a big portion of the stock market as well. But the Fed committing to do this through 2022. And by doing this, in order to do this, they need to print new money. This is their balance sheet as a whole. We can see that back in 2008, it was under $1 trillion. They grew it during the Great Financial Crisis. They promised there was a temporary measure that they would shrink it. They would let these treasuries and mortgage backs roll off, but they never shrunk it. And when they tried to shrink it back in 2018, as I said, it caused a mini stock market crash. So essentially, since 2008, we've gone from under $1 trillion now to over $7 trillion. And the only way they buy money, they buy assets to put on their balance sheet, they print new money, which destroys the purchasing power of the US dollar. This is one reason that bread no longer costs 7 cents and you can no longer get a pound of steak for 26 cents. They've completely failed in their mandate of stable prices, maximum unemployment. Interest rates are going close to zero, which disincentivizes savers. It's a complete disaster. And even the stock market rally so far this year, if you measure it in terms of gold, the stock market is actually down on the year. So over on the left side of this chart is the stock market for 2020. So if we scroll out here too, we can see that we're really, the stock market has been depreciating relative to gold for a very long time. So we scroll out and look at the monthly values. We are actually back to call it roughly 1996 levels. So in most cases, you're better off actually holding gold than holding an index fund because of this. The stock market has basically gone down in gold terms, which is not an arbitrary way of measuring things. Gold tells you what your purchasing power is, and so the S&P has not really kept up with inflation and has not preserved purchasing power. So if you're storing your money in the S&P in an index fund, you do this because you want to increase or at least maintain your purchasing power. And this has not been true in 2020. It's not really been true since, I guess it's basically held its purchasing power since 1996 with a lot of volatility along the way. The good news is for holders of gold and especially holders of Bitcoin, none of this really matters. In fact, it's quite bullish for Bitcoin. This is one reason I had almost used the title, Fed promises to pump Bitcoin for the next 2 years. Whatever the Fed does, they cannot hurt Bitcoin. Bitcoin has fixed value. They can't just be printed on a computer. like the Fed does with US dollars. The Fed cannot print gold. They cannot print Bitcoin. These are scarce assets. And as such, the more the Fed keeps this really inflationary monetary policy, the more Bitcoin will go up and the more gold will go up. So that's a brief history of the Federal Reserve, its failure as an institution, how it's contributed to the loss of wealth, the loss of purchasing power, the loss of employment, and all of which came with a lot of volatility along the way, a lot of crises, a lot of a rolling series of bubbles that the Fed has to keep reinflating. And the way it reinflates it, the only tool it has now is actually printing new money. Again, very bullish for gold and Bitcoin. Please hit the like and subscribe button if you found this helpful, and let me know your questions and comments in the comment section below. Hope you're all staying well, and I'll see you in the next video.